Okay, thanks everyone for reading through those disclosures. As I said before, my name is Natalie Beckett and I will be your moderator this afternoon for one of Avant-Garde Trading's free educational webinars. This afternoon we have Wendy Kirkland with us. Wendy, are you there?
I am here. Glad to be here.
Glad to have you. Thanks so much for joining us. For those of you guys who don't know, Wendy is going to be talking about her winning secrets from a professional options trader. So if you guys have questions during the presentation, please put them in the Q&A or chat box. We are going to hold questions until the end of the presentation. So at the end, time permitting, we'll go ahead and field those questions over to Wendy, all right? So Wendy, with that, I'm going to give you the reins, and you can go ahead and take it away. And I always love the story that you tell about how you got started in this business. If you wouldn't mind sharing that with everyone, I think it's so interesting.
Okay, I will do that. Thank you. I appreciate being here. Let me get all the proper buttons clicked here and we'll get started. There we go.
Yeah, I
think that'll do it.
Yep, go ahead, Wendy.
All right, great. Thank you very much. All right, for those of you who do not know me, I'm Wendy Kirkland and I'm a full-time option trader. I've written a number of books and strategy books that help other, I guess you'd say just kind of average retail traders, just everyday people like me, be able to navigate the market and trade options. The way that it all came about was rather interesting. I listed here a few ways that people often come to the market. You know, you could have somebody in your family involved or your education or profession. Many people come by financial needs, and that was my personal situation, was the fact that my husband and I ran a retail gift store in Asheville, North Carolina. He is a decoy duck carver, and he carved the ducks and I painted them, and our shop was an outlet for our decoys. And gradually we added other local artists, pretty much nature-related work into the shop. And in 2004, we were hit by, it was then Tropical Storm Francis that came through and flooded our business. And we did not have flood insurance. Who thinks that it's going to flood in the mountains of western North Carolina? That's like crazy. And we were pretty much wiped out. We were a small family business that just had everything involved in the shop, our retirement and sweat equity and so on. And then 2 weeks later, Ivan came through and did exactly the same thing, that we had no more than kind of slopped out the shop and tried to get rid of the mud and the debris that had was there, and it happened again. And it was really devastating. And a friend of mine took me to lunch. It was close to my birthday, and she mentioned something about options, and I had no idea what she was talking about. And I took a couple classes, and it was a really, really good fit for me. I learned just enough in those classes to get into trouble. And from that point on, I really jumped in with both feet to really study. Anytime I had something that just didn't go my way or that I didn't understand fully, I would jump in and do as much reading as I possibly could. And when I finally started having some winning trades and all, I decided this was something that I could teach other people. And so I wrote my first book called Option Trading in Your Spare Time, and that one was geared toward women. It has a bright pink cover, and there was a lot of men that carried a bright pink book around, or they slapped some grocery sack around it, brown paper. But anyway, that led to the strategy books that were listed on the previous page. So at that point, my personal goal was to get out of the bind we were in and perhaps achieve financial independence. And as I mentioned, that desire grew to sharing and helping others with that same objective. So I wrote some strategy books. I do newsletters. I do coaching and do advisory services, which can be auto-traded through Avant-Garde. Natalie gave you a disclaimer to look at, and I'm doing this as well, and it's important for you to read through and for you to really take to heart. You don't want to trade with money you can't afford to lose, but it is important because it is a learning process, and that along with winning trades, there are going to be some losers. So you have to be able to balance that and take it into account. This is a little personal note that I want to share with you, and it's just that you should never put off in life, don't postpone joy, to check in periodically to make sure you're being present in your interactions with your family and co-workers, and to understand that the past is done and the future may never come, and to really enjoy the moment. And part of the reason that this came about for me, matter of fact, tomorrow, August 3rd, is the anniversary that my husband had a very serious car accident. And he's doing fine now, much better, but this has been a real struggle this year. And so this was just a real eye-opener for me as far as don't put things off, you know. Don't put off saying or doing what's important or meaningful to you. Be grateful every single day for every single minute, and forgive quickly and just move on. Life is too short. All right, my first suggestion or hint or trick or whatever you want to call it is that there are definitely divisions within the trading day. The first hour of a trading day, and it really isn't a 30-minute hour, it's more a period, the initial period of trading where traders, where trade orders that were placed overnight are filled, and there's always a knee-jerk reaction to whatever is happening in the news, and this becomes built into the market. And so often the first hour of the day is called the rookie hour or amateur hour. And this is the time when new traders see what's going on in the morning, they see the morning move, they get all excited about a trade, they jump in, they have their order filled, and then as the market fills these orders and settles back down, their premium drops. And sometimes it drops enough to even hit what might be their stop. And so they're in and out of a trade within minutes, so they've paid their trading fees, and then a short time later it reverses and heads back up. So this doesn't mean that the market might not climb back up and move beyond the order fill amount, but it does mean that the new trader may have been able to place their buy order at a lesser premium. And then as it moves past that fill amount, they would already have gained a profit. Now, the last hour, again, not necessarily a 60-minute hour, is called professional hour. And this is where professional traders and money managers often take profit or make purchases for the next day. Now, we're going to look at this, what it looks like in a chart, but let me go through the other stages of the day. So, considering the morning, the amateur hour, let's say that between 11:45 and then 2:15 could be considered a lunch hour. And during the time period, the price of stocks will slip as traders take a break and go to eat and then return for the afternoon session. So the morning session can be anywhere, say between 10 and 9:15 to noon, which is kind of approximate Eastern time. And the afternoon session then is between, say, 1:30, 1:45 to 4 o'clock. And again, the minutes are not hard and fixed periods, But once you start paying attention, you'll be able to bring up an intraday chart and see the reversals that take place, whether it's a morning reversal or a little pullback during lunch or what's taking place at the end of the day. Now, the hourly market timing really has nothing to do with whether the stocks are likely to be up or down during that particular trading time. It's more that there's apt to be a transition during those periods. And they may go from up to down or down to up or from either up or down to flat. And then there's days that just defy everything and they're just not what you would call usual. So here's a chart. This is NVIDIA. And you can see that here on the 28th, if you just go up and you look at this kind of stick candle here, that it went up as high as almost 72, say 71.75, and as low as 70.75. So that's a dollar move and closed right at $71. So in this particular case, had you got excited, entered your trade, you very well could have been filled somewhere up here around 71.75, only to have it drop down lower and then close at $71. So now it has to go, and we see this happening in the next two candles. It would have to go up that 75 cents for you ever to even break even again. So it is better to let that first period go by, see how things settle out. You could have purchased then at around $71, and by the time it got up to where your entry may have been, had you entered right away, you then would be in profit some amount based on the delta of your expiration, benefiting from that 75-cent move. And then here we are at the lunch hour. It's kind of marked here with the arrow. It flattened out during the last, say, hour and a half, and then pulled back during the lunch period, and then dropped more during the afternoon and kind of settled out and went flat and then dropped a little bit more. Now, chances are this would have been a low based on what was happening over here on the left side of the chart. But it goes to show that there are divisions within the day, and you can see these on a regular basis. And it is just wise to be able to take advantage of them so that you're placing your trades at the most advantageous times. All right, the second little hint or clue is that there's a great many ETFs that trade an extra 15 minutes. And ETFs are exchange-traded funds. They're a basket of equities. Usually they have some theme to them. They might be all NASDAQ-related stocks like in the Qs. They might be sector stocks so that they're bank stocks or financial stocks or industrials or healthcare. And they have, ETFs just in general have become very, very popular because they are less influenced by, say, the earnings activities or company events than an ETF is. An ETF, because it's a basket of stocks, are not, they're going to go up or down. A basket of ETF that had Apple in it. Today, with Apple going up, your ETF would have gone up as well, but it doesn't go up to the same degree. It is balanced by the equities that are within the ETF. And so by having these extra 15 minutes to trade, sometimes you can capitalize on earnings reports, so that if you were to be in the queues and be holding the queues, and Facebook reports after market close at 4 o'clock and maybe at 4:05 their report comes out and they do really, really well, your Q trade could very well go up, and you have the opportunity to be able to close that trade within those 15 minutes and be able to take profit. Now, sometimes during the time period, the spreads widen a little bit, so you have to be aware of that and be able to, if it's not too much, and with the ETF often it's pennies, then it all balances out and you'll come out on the winning side of that. My third little hint is the fact that you can focus on stocks that have consistent big moves. And the way that you can do this is to apply an indicator called average true range to a daily chart. So it's called an ATR. And so I've attached an ATR here. And this is Alibaba's chart. And what you want to look for is about 2% daily average move. So if we look down here, I can see that price is on this chart is $101. So in my head, I can easily flip that and say that that's $2.02 as far as a 2% average move. And looking at the indicator down here, I can see that the ATR is $2.15. So this would be a great candidate because it has regular 2% moves on average. Now, it has been proven, I guess you'd say, that often a 2.5% to 4% move in price is a double in weekly options. So you don't have to hold a stock that moves 2% for very many days before it is apt to double your weekly option premium. It takes a little bit bigger move, 3 to 5%, for it to be a double in a monthly option. Okay, so the fourth little key here, and this one takes a little bit of explanation, is to be able to count distribution days gives you kind of an overall health of the market. It's like taking the temperature of the market and being able to tell that it's starting to not feel well and may fall ill. Otherwise, you can tell that it's robust and feeling strong. And what a distribution day is selling by the institutions. And there's two kinds of distribution days. There's regular distribution and there's stalling distribution, which is high volume, but price doesn't go very far. And so as a general scale, like a mark on a thermometer, that when you get to a point where you have 6 distribution days over a relatively short period of time, and that short period of time is about 25 days or 5 weeks, 5 days in a week, 25, that if you have 6 days in over that period of time, over 25 days, then the market is getting to a point where it's starting to show some weakness, and that it very well could roll over and be ready for a pullback. And after a 25-day period, the days start dropping off. They no longer influence what is happening. So you could have 6 days and then have a day drop off because it's older than 25 and you're down to 5. And then you could have another one drop off there at 4. And then all of a sudden you could have 3 days in that accumulate very quickly. And that is a greater sign of building weakness. If you had 3 days and 2 weeks couple days in a week even is shows building bearishness. And so once it gets to the point you have 6 solid days and you go into the 7th and maybe an 8th, then the likelihood of a pullback is going to happen. So there's a cycle to this, and the way that it goes is you start off with the uptrend being in a confirmed uptrend. And from there, it goes to the uptrend being under pressure. And so when it's building up and having 5 and 6 days, then you can have the market be under pressure. And so that is showing that it has this weakness. Then it can roll over and be in a correction. And we would have one of those 5 to 8% pullbacks, or it could be a major one, which we haven't had in a good while. And then from there, you need a follow-through day. And once you have a follow-through day, you go back to the confirmed uptrend. So that's kind of the cycle. Confirmed uptrend, under pressure, correction, confirmed uptrend. Now, a follow-through day often happens somewhere between day 4 and 7 of a rally attempt. So maybe you've had this pullback, this sell-off, and then you have a couple up days. And then somewhere between day 4 and 7 of this rally attempt, you have a big up day. That is your follow through, and that is what will throw it back into the confirmed uptrend, and then it starts to recover from that pullback. Once the uptrend starts again, back to the confirmed uptrend, all the previous distribution days are wiped out. And so to do this, it's pretty easy, actually. You would just take your daily chart this is the NASDAQ, and you count back and see what 25 days are. And then you look for any day that has a big kind of selling candle and the volume is higher than the previous day. So I've marked these on here. Some of them are more recognizable than others. You have a big candle like that and higher volume, you know that is a distribution day. So here's the S&P counted back 25 days. This is a distribution day, and this is a distribution day. Right at the moment, there is 3 distribution days for the NASDAQ and 3 for the S&P. Now, fifth little hint, and a lot of traders don't understand this, that there are 2 types of volatility. A lot of times people think volatility is the VIX, the VIX, and you can look at a chart and see what the VIX is, and it's been very low lately. But that is not the same volatility that's involved with option trading. And so implied volatility is an aspect of the options price that is backed out from the price. And implied volatility shows the expectation of future volatility. This is what the market makers are thinking is going to happen in the pricing. What's going to happen down the way? Historical volatility is a measure of the volatility of the underlying stock, and it's the known volatility, and it's based on the actual recent price changes of the underlying equity. And so the historic volatility can be thought of as the speed, the rate of change of the underlying stock. So what we want to do as option traders is want to have there be a balance between the implied and historic volatility. That when the implied volatility, what is going to happen down the way, is higher than the historic volatility, you're going to be paying a higher premium. So let's just use a quick example. If you had been thinking you wanted to do a trade on Apple, and say you got in yesterday afternoon, late in the day, the premium that you paid would have been increased based on the excitement of what was going to be happening with Apple reporting earnings yesterday. And you would have paid a higher premium than someone who had maybe purchased the day before or maybe even earlier in the day. So historic volatility that is higher than the implied volatility is then a premium that's a bargain, and you're getting something that is on sale in a sense. And when the implied and the historic are very nearly the same, that is just a very fair premium value. So let's look at how you can figure this out. That some of the brokers will have what is called a volatility chart, and that's what this is. And you can see that this is Johnson & Johnson, and it's a 30-day volatility. This actually is available through iVolatility.com. I don't have anything to do with them, but it's where I got this chart. And you can sit and see that the historic volatility is 14.51, and the applied is 14.473, and that's very, very close. You can see that with the lines that they're, the blue line here is the historic, and the mustard-colored one here is the implied. That there are times when the implied has been high here on this period between March and May, and then there's other times where the historic was high back here in January. So you want to strive to have it be where they're very close or that it's at a bargain. Let's look at one. This is Amazon, and this is to show you how it can be different. So here, its historic is 15.37. The implied is 34.31. That is like double. And so that if you had been considering an Amazon option, you'd be paying a high premium for this. And the only time that this works out, if you were to say, well, I just really want to participate and I want to get in, is you have to know that you have to sell again while the implied is still very high. So that this is not the time to get into a trade that you are figuring that you're going to hang on to for a long time, because you will end up having the implied lower soon after the event, and you will be caught in what they call a volatility crush, where the volatility implied is changed and maybe drops down closer to the historic, and it comes out of the premium, and you will be losing some of your premium in the change. Okay, the sixth hint is the fact that if you decide to select at-the-money options, that there is one Greeks, the gamma, and that can work in your advantage. So the gamma is a Greek element that determines the amount of movement, and gamma is the amount of theoretical options delta will change for a corresponding 1 point change in the price of the underlying. In other words, if you look at delta as your speed of options position, then gamma is the acceleration. And at-the-money options have benefit of extra gamma, and it's like an extra boost in the premium as it pops up and goes in the money, so that it's like when it crosses that line of going from being at the money or just out of the money, and it's usually the strike is one out of the money. When it then goes in your direction and pops up and is then in the money, you are going to get the benefit of that extra gamma. So this is at the money option chain and very generic one. Just wanted to point this out for new traders that just are not used to what a chain looks like. The 4650 down here would be the option that is considered at the money. I say that, I look at it, and I've actually misspoken it to a degree, that the current price is 46.20. The one that is just in the money is at $46. So it's 20 cents away, where the 46.50 is 30 cents out of the money. So that the 46 is closer to being at the money. But the gamma is that I'm talking about really would be in this 46.50 that popped up to be in the money, where at the moment it is at the money, but just out of the money. Now the seventh bonus, if you want to say, is the most successful option trades include three very specific aspects. And I don't care whose system you're trading or what strategy you are following. The very best, most profitable trades are going to come from when an equity is either overbought or oversold, then has a reversal, but a confirmed trend reversal. So whether it's way up or way down, when it turns, either going from being oversold and starts rising, or overbought and starts dropping, that is going to be the type of move that holds the biggest profit potential. And then you want a trade entry signal that confirms the direction and that the time is right to enter the trade. So I'm going to share with you, and this is something that you can use right away in your trading. One of the things that I am most known for is the P3 squeeze. And the way that is formed, if you want to say, is between two indicators that have nothing to do with each other. I always say that the reason that I recognized this and kind of jumped out at me was the fact I'm an artist, and I'm not approaching the market from the normal financial background and so on, that I see things in patterns and see things a little differently. So I put a CI indicator on here, and this is an oscillator that shows oversold and overbought. And so this brown area down here is shows that Celgene is oversold. And as it rises over the -100 line, it's helping to show that it is switching and reversing from this period of time that it has been oversold. Now, I also have here a PPO and an ADX. And this is where I'm saying that I discovered the pattern that I call the squeeze pattern, that the PPO and the ADX, they have nothing to do with each other. Calculated different, they have no correlation at all. But what I noticed, like in this area that I've circled here, that when the lines squeeze in together and then start pushing away from each other, price is going to go up. Now, the PPO crossing up over its signal line is the trend change, and then we have entry signal. So we have the three elements that I talked about. One is the fact that this is oversold, and we have the trend change with PPO crossing up, the lines are pushing away from each other, have our entry, and then there's the pop from the squeeze, and this very well could be our exit. A lot of times I will exit when I have a really nice gap, because often gaps are filled or it drops down from there, and I just figure it's a gift. I caught the gap and I got most of the profit, and I am out. So those are the three elements. I think I have another example here that I can show you. This is actually the P3.5 pattern. So this is the short pattern that I taught for a good while, the P3 pattern, and those are a number of the books that I showed earlier on. And I taught how to trade that. Everybody was so happy and glad to have something that was so clear to be able to see when to enter and when to exit. Excuse me. And then they're saying, well, Wendy, what about short trade? We would like something that is equally as clear to be able to trade puts. And it took a long time for me to figure it out. And it was really pretty obvious, but it still took a long time. Here you have the CCI again. We'll start with the first element of our three, and that is the fact that it's overbought. That's this green section that's up here. Notice that it's had a nice run up. It's overbought. And we have the PPO crossing down, showing that it's going to go down. We have this drop down below 100. We have our entry, and there it goes. As these lines push away from each other, the price is going to drop, and there's our exit. So this is kind of my thing, I guess you would say, that I have these patterns. They have very specific stages that they go through. I can look at any chart. I don't care what chart it is. Any chart, any time frame, and look and know exactly what stage of either the P3 it's in or the P3.5, and what is likely to happen next. So that is my little niche, I guess you would say, in my teaching and training. So information about